Huh? No, waiting for the guy. Yes. Second. What's up, Travis? What's up, Travis? Thank you for joining. Without further ado, let's begin. Bears are eating my life. Which kind of bears? Real ones? What's going on? Okay, now I'm even more confused. Is this some kind of American slang? Not familiar, that I'm not familiar with. Red Day. Not sure. Oh, okay. Now I get it. Okay, now I get it. I was thinking about actual bears and stuff. I guess too much YouTube recently. Okay, yeah, let me see. Let me see. What about me? I haven't checked my portfolio the whole day today. Team Bear. Okay, so my first one, yes, is minus 1.5, minus 1.37. That's okay. And this is like what? $100. But first part of the day it was plus, like all the way until 1 p.m. everything was good. Second one, Arc this, Corsair this, Reg this. Second one approximately the same, I think. But okay, that's normal.
It is. It's probably healthy.
Yes, it's normal. I only wish this happened right before me buying stuff, but it's okay.
This would be a good day to buy right now.
Yes, but the decline is not that much, at least for me. That's like
No.
minus 1.3 for my a little bit more risky portfolio. So I would assume that my value portfolio, the first one, is even like 1% maximum. Not a big deal. Good. I've seen worse. Okay, so where is this? Okay. First like this. So today, most likely no one else will join. So I guess we can just go pretty quick and stuff, like we always do, pretty much. Okay, so today we are speaking about investing versus trading. Speaking about today, I would say the easiest stuff to understand, Like literally, like as soon as you understand this, you would not look at investing any different than that. Every single person before they start investing, and I'm sure maybe even you are like this, definitely everyone around me who I know and who is investing, they were like this, at least in the beginning, and they're still like this. I was like this. And what do I mean like this? In the beginning, when you're not familiar with investing and stuff, your idea of investments is what? You buy Apple shares for $100, you wait until they become $110, you sell them. That's it. Your idea of investing, I would say of more than 90% of people who just start learning about investing, for them it is to buy low and as soon as it makes profit just to sell it, and then once again wait until the price drops, then buy it, sell again, and repeat until you're a billionaire. Like theoretically it's a perfect case scenario, theoretically everything is awesome, theoretically everyone is a billionaire, but in practice it's not so perfect, not so easy, it's not the same. And today we are going to talk about investing versus trading, the major key differences. And once again, as soon as people see it, hopefully you already know it. So basically, I'm just refreshing, just making some additional points that you might never heard about before. And also for people who are watching the recordings, especially Gabriel. What's up, Gabriel? Thank you for watching this recording. I know you do it. So today, investing versus trading. So the topics, as you've seen already, most likely in the Instagram group. First, I'll just give the definition of both investing and trading. Then I'll give the purpose of both investing and trading. Then I will do the analogy of marathon versus sprint. It's like very basic analogy. It's I have like if you've seen Interstellar when the person was describing how wormholes work, and he just basically folded the piece of paper and penetrated it with the pen. Every single person after this movie started explaining wormholes the same. So this is the same, very basic explanation. Everyone understands it. Like, so why not use it? I guess. Like, I don't need to be creative or anything like this. Create my new way of explaining the differences. Like, if it's simple, if it works, I'm just gonna use it. Simple as that. Then obviously quick summary because lots of points will be talked about today. And in the end, if there are any questions, and they will be answered, obviously. Okay, just for the purpose of respect to my patrons, see if anyone is joining, no one is joining. So let's begin. First of all, definition of investing. I personally, when I was studying investing in the very, very beginning, my second book about investments was The Intelligent Investor by Benjamin Graham. And at that time, I didn't know that this is supposed to be kind of hard to comprehend book. It was supposed to be hard to understand book. I just knew that this is the book that everyone is talking about. This is the book that even Buffett suggests himself. And I was like, okay, I'll just read it. I was like, because now if I see like people suggesting this book or if I read about this, and after especially reading it myself, I know that this is kind of a complicated book to have your second book about investments, like because there is a lot of terms and stuff like this and that. But I was not reading it, I was listening to audiobook, and I was listening it like so attentively, like I was listening it like I actually enjoyed it. Lots of people say it's very boring and stuff, and I can understand it, but I was so interested in the book. Like if I didn't understand something, I was just putting like 1-2 minutes back and listening to this again all the way until I understand this. If there is some unfamiliar term, I just stop the book, I Google this term, what it means, and then I continue listening. I wanted to make sure that I understand every single sentence of the book. And just by reading this book, besides this book giving me lots of knowledge, the amount of research I did while reading this book, it is what basically made me basically like laid the foundation of my investing, financial literacy, let's say. So, okay, not just investing, but financial literacy. So the book is like, I don't remember exactly, like 600 pages or something. I spent maybe like a couple of months reading it, actively reading it. There was sometimes moments that I spent like almost hours listening to the same 2-3 minutes fragment of the book because I was listening to it. I didn't understand. I put it back. I listen again. I don't understand. I put it back. I listen. I understand the beginning, but I forget about what was in the beginning when I was already reaching the end. So I put it back again. So like I said, I made sure that I understood every single sentence of the book. Obviously, I was also listening to this book in English. So maybe later in the future, when I already would have read like whatever it's past future perfect future perfect sentence or whatever, maybe in the future whenever I read already all the fundamental books about investing and finance and all the other great books like of the world, let's say, so maybe I will come back to the Intelligent Investor and I will just want to listen to it in Russian this time, just to see the differences, so there are no language barriers, even though English is pretty easy for me and stuff, just to read it again with all the knowledge that I got already, like I will get at that time when I'll be listening to the book for the second time. Because like I said, this book, even though it's fundamentally one of the best books about investing, I read it as my second book. I read it very early, I would say, in my investing career, if you want to call it like this. But because I spent so much time trying to understand it, this laid so big, so strong foundation of the whole financial literacy that I have at this very moment. And in this book, the author, who is obviously Benjamin Graham, he said that an investment operation is one which, upon thorough analysis, promises safety of principal and satisfactory return. At that time, I spent maybe like several times listening to this phrase. I got the idea, but still it was like kind of confusing. Like what does it mean? What does this mean? What does that mean? Like which kind of principle? Like okay, you like what do you mean satisfactory return? Later, it all made sense, obviously. So, and in my words, basically, long story short, if you're investing, it means you are, for example, $100, the same $100 you invest in Apple. You invest this money and later you want to get your whole principal back. Principal is the original amount of money you invested, $100 in this case. So right now you invest $100 and in the future you want safety of your principal, which means that you want that your principal will not get below whatever you already invested. So which basically means you don't want your money to fall less than $100. And satisfactory return is basically like return, like whatever amount of money is made on stock market, 10% per year, 15% per year, like whatever it is. Yes. So long story short, investment is investing money and hoping that in the future, whenever you sell your shares back, you will get more money that you initially invested. Very obviously basic, very like self-explanatory meaning, like everyone understands investing exactly like this, but this phrase is so cleverly built that I don't think that there is any more clever way to say to describe investing. There is no more clever way of describing investing more clever than this. Because if you say you just want to invest your money and get profit, like yeah, kind of idea is the same, but you can ask several questions, like what kind of profits, like how much money, no, this and this and that. But in this phrase, every single word makes perfect sense, and as soon as you understand completely, there is literally no questions left to ask. And so to invest, once again, is to commit money to the stock market and expect to receive it back plus profit on top. So this is kind of my way of explaining the phrase, which I spent like maybe 10 seconds writing. I didn't give any thought to this phrase that I wrote, but like you get the idea. Long story short, invest money, do not lose it, and make money on top of this money. This is what investing means. Okay. No questions, no one joined. And now the definition of trading. So operations that are not meeting previous requirements are to be called speculations. Speculations is basically synonym for trading. Whenever you're trading, you're speculating. Speculating means you assume that the price will go up and down, you bet on this assumption, and then if you're correct, you make money. If you're not correct, you lose money. So this is speculation. And previous requirements, once again, investments is the let's make it very precise. An investment operation is one which, upon thorough analysis, promises you safety of principal and satisfactory return. If you're not putting your money to work with this idea that you did thorough analysis, that you did good analysis, I mean, that you want your money to be safe and that you want to this money to bring money, if you're thinking anything other than this is already a speculation, this is already a trading. Which basically means if you are trading, you do not commit yourself to a long-lasting relationship with any particular company. You just extract profits from its prices going up and down. So as you can see, investing is investing in a company, and trading is literally just profiting from prices of the company going up and down. You should not care about like what's financial condition of the company at all. You just draw charts, you just do technical analysis, moving averages, support resistance levels, all this kind of stuff. As soon as the price breaks the support level, as soon as the price breaks resistance level, you enter positions, exit positions. Like you as a trader, you do not even need to read the financials of the company. Like I would say that maybe just listening to the news, reading press releases is more than enough for you, because all your profits that you are getting from trading are short-term oriented. Okay. Let's see if anyone joined. No one joined. No questions. Okay. So the purpose of investing. If you are investing, you want to grow with the company you gave your money to. So like you become the owner of a small part of a company. And this is like exactly share. What is share? What is stock? What is equity? All these three things are synonyms. Stocks, shares, equities, like it's all the same. But the best way of thinking about investing is when you're using the word share, because like share, it's like it's a part. It's literally, it's another synonym for part. And you are buying shares of a company, you are buying parts of a company. And obviously, if you are now the owner of the company, you want this company to succeed. You want this company to grow. You want this company to be profitable. You want this company to like make money and make money for you in return. And as soon as it starts making money, as soon as it's financially healthy, as soon as it's profitable, it starts growing and you grow with it. So which means that your money that you're invested, it becomes more valuable, they appreciate in value, and you make money through investing in this way. Investing in this case is a long-term commitment, because sometimes good investments, really good investments, they take time to prove themselves. Like I've been telling already many times. In trading, you can extract daily profits, $200 per day, $100 per day, maybe $500 per day. But investing, it can be like we just saw today, minus 100 in here, minus 500 there, but next day it's plus 300. Like investing is long term. If your company is good, if your company is financially strong, that's why first part of the definition of what is investing by Benjamin Graham, he said, which is upon thorough analysis. That's the thing. You need to analyze companies. You cannot just blindly invest in a company just because previously the stock price was high and now the stock price is low. So you're investing in it because, well, it's supposed to come back to high price again. Well, no, am I right? No, it's not like this. 50-50. It's gonna either come back to the previous levels, maybe it's not gonna come back to previous levels, maybe it's never gonna reach its previous levels, maybe it's gonna even go bankrupt completely. You never know. But what I know, that if there is no recession, if there is no correction on the whole stock market, and your company or company that you're interested in investing or trading loses, like, let's say, so 30% of its value, it's definitely not a good way to just buy it because now it's a discount without doing the research why the price declined so much. Maybe financials are good, maybe financials are bad 3 quarters in a row. Maybe some qualitative fundamentals changed. Maybe company is not going in the same direction that it's supposed to go since the beginning. Maybe something changed. Maybe top management is doing unlawful things, I don't know, like whatever. Just investing in a company because prices dropped from its peak prices is almost never a good idea unless you do your own research why that happened. So, like I said, investing, it takes time for stocks, for the companies to prove themselves sometimes. Like, for example, perfect example, Carnival. I'm holding Carnival like what, since May, I think, since the beginning of May. And last month was just the first month that the company finally proved itself. And this is like what, since May until November, like I don't know, like what it is, like 8 months, 9 months, I don't know, something like this approximately. Yes, more than half of the year. It took more than half of the year for the company to prove itself, even though nothing fundamentally kind of changed. It's just that the president elections, Democrat won, so maybe there will be, uh, maybe cruise lines will be, I don't know, like I literally don't know why it exploded so much. It was 70% explosion in just 1 month. But because I'm an investor, I do not care about monthly prices. It's awesome that one company exploded so much in just 1 month in my portfolio. But still, cruise lines are not back. Still, companies losing lots of its money. So, in my opinion, as a value investor, this explosion is not justified. Obviously, it feels good, but it's not justified yet, because the next financial report of the company, we will not see any gains in revenues and net income, nothing like this yet. The company will still be burning lots of cash literally daily. And I'm still waiting for it. I'm not selling it now because I got my 70% quick gains or anything like this, because I know as soon as the company is back in business, as soon as cruise lines are back, this is when I'm most likely hoping for company to explode even more, maybe even triple digit growth. This will be unbelievable. If there is a triple digit growth, like 100% per month or something like this will be just unbelievable. But if this happens, this is when I will start already might be looking into selling the company, maybe, just maybe, because this investment for me is the category of investing in recovering companies. And like, even though investing is about long-term holding, but still kinda it is suggestible, if you're investing in a company that's recovering, sell it as soon as it's finally completely recovered. So as soon as the cruise lines are back, as soon as the financial report shows that increase in revenues like 10,000%, I don't know, whatever it is, yes, then maybe it's a good time to sell, because then it will reach its peak and then the situation will stabilize. And then maybe a couple of months later, when there is a new financial report, maybe if the price drops, because it will be a huge hype. As soon as cruise lines are back, it will be a huge hype. Everyone will be investing in cruise line companies because everyone will be fearing on missing out. So as soon as this hype dies down, maybe if the company is good fundamentally, if the financials are good and stable, maybe I'll re-enter the position later. But now I'm thinking maybe, just maybe, if the Carnival explodes and if cruise lines are back, maybe I'll consider selling it, looking at my profits. I don't know whatever it's going to be in the future. And maybe later I will re-enter the position, assuming that the company will be good and stuff like this and that, basically. Okay. And purpose of investing, last thing, you need to invest in good companies with potential. Basically what I was saying previously, if you're trading, you just trade prices. You do not care about the company's financials or health or anything like this. But if you want to grow with the company, if you want to make money with the company, you need to invest in a company that has the potential to grow and potential to make money. And this potential need to be long lasting, not just like 1 year of this and then that's it, we're done and we're not doing anything else, not developing new products, nothing like this and that. Okay, let's see, no one joined, so let's continue. Okay, the purpose of trading, all you care about is buy low and sell high. And this is, like I said, this is almost 90% of people. I would even maybe say more than 90% of people, whenever they want to start investing, they think like this. My relatives are asking me questions. So like, what do you think? Is it a good time to buy now? Or like, if they already bought something, okay, so do you think I should sell now? Is it like already high price enough for sell? They think they're investors, but they're traders, because they bought the company just waiting for these prices to explode, to go higher, and then to sell it and to lock in their like 5, 10, 15% profits. This is trading. You do not trade. You do not trade companies. You trade prices. You do not invest in prices. You invest in companies. So remember, invest in companies, trade prices. If you are thinking about buying low and sell high, you are trading prices. If you are if you are investing in a good company and you want to grow with this company for many years, you are investing. Sometimes you can hold investments for 10, 15, 20 years. Like, I don't know, maybe one of such investments in my portfolio will be Apple, for example, AT&T, maybe Caterpillar. maybe these three companies will be the companies that I will hold in my portfolio all the way until the end. 30 years from now, I'll be still holding maybe those companies, because Apple is I just like this company. This is one of my favorite. Caterpillar is also one of my favorite. I see Caterpillar heavy machinery like literally everywhere. Every time there's a road service or anything like this, it's Caterpillar, Caterpillar, Caterpillar. And financials are very good for this company. And it's pretty undervalued. Okay, just got some emails. I'll see later. Okay, and what else? And AT&T is just, it's stable company. I'm not expecting it to grow much. I'm not expecting it to grow maybe even more than 5% per year, but its dividend yield of 7%. This company I'm literally mainly holding just for dividends, because whenever you're calculating annual growth of the company, it's not just how much stock appreciated. So for example, the stock was $100. At the end of the year, it became $110. Yes, in this case, the company gained 10% of its value. So the growth rate is like return is 10%. But you need to also include dividends. If the company is paying dividends, you also need to include dividends. So that's what I'm saying. If AT&T is increasing 5% per year, if AT&T's return is 5% per year, you add 7% dividend yield to this number. So your return on AT&T's investment is actually not 5, but 12%. So that's what I'm saying. I do not care about AT&T growing slow. I just have it for kind of good stability. And this is like one of the leading companies in the USA about like home internet, phones, phone internet, phone plans, like anything. Like, well, you know what is AT&T, obviously. So this company is most likely not going anywhere soon, and it pays very, very good dividends. So its payout ratio is dangerous high, but this is a dividend aristocrat company, and this is the company that they know that majority of investors hold AT&T just because of its dividends. So as soon as they cut dividends, it's going to be a disaster. This is the most known company for its dividends. As soon as they remove their literally one competitive advantage, like for me, there is no reason to invest in AT&T other than its dividends. As soon as they cut them, that's it. Like there's no reason for me to hold it anymore. I will most likely sell it and stuff like this. I got my dividends already, so I don't need it anymore. It's not paying dividends. And most likely millions of other investors will do the same. For this reason, I think that AT&T will do anything possible to maintain paying its dividends, because that's literally the only thing they're known for in investing world. Okay. So once again, about trading, all you care about buying low and selling high. You do not invest in companies, you just trade their prices. And in case of short selling, which I think you know what is short selling, you want to sell high and buy low. And just in case if you don't know, or if Gabriel doesn't know, short selling means the following. You borrow shares from your broker, like Simple, for example. Let's talk about Canada. Or Robinhood, doesn't matter if you're from USA. So you borrow shares from your broker, you sell them, and then you need to return those shares. So then you buy them back and return them to your broker. So in case of normal trading or investing, you buy low, you sell high, and your profit is the difference between your purchase price and your sale price. So whatever it's called. Selling price, yes. But in case of short selling, your profit is from selling high and buying low back. So let's say you borrowed one share of Apple, sold it $120. So you pocket $120 in profit, and then you buy back one share of Apple for $110. You return it to your broker, so you just give them back $110, and that's it. In this $10 is your profit. 120 you sold it for, 110 you bought it for back, you return it, $10 is your profit. This is what is short selling, long story short. So you can trade companies in any condition. I just made a mistake. It's not you can invest in companies in any conditions. You can trade companies of any condition. Once again, in investing, you want company to be financially strong and healthy. So you want to grow with this company together. And in order for this company to grow, it needs to be able to grow. It needs to have good potential. It needs to get healthy financials, healthy balance sheet, healthy income statement, and stuff like this. But in trading, you do not need to care about this. All you just do is do patterns like flagship stocks, whatever they're calling this, triangle, reverse triangle, blah, blah, blah. All their like moving averages. All you wait is for the resistance support levels to be broken. So you enter the position, exit position, profit from price fluctuations. And that's basically simple as that. And obviously in case of trading, there is almost never long-term commitment to any company. Sometimes people do day trading, which means that they need to close every single position at the end of the day, because during night, during the time when the markets are closed, something significant can happen. So on day traders, they prefer not to risk. So sometimes it's just 1 day commitment. Sometimes it's even minutes. Or if you're a scalper, scalping basically means as soon as the price goes up even 2 cents more per share, you sell it immediately. So you literally pocket like $5 per trade. I don't know. In this case, you need to be leveraging your trades, because if you're not using leverage, which basically means borrowing additional money to increase your purchasing power from your broker. So which basically means if you're not using leverage, you can buy like 10 shares, sell them, and then your profit is 20 cents. It's not worth it to make profits 20 cents per trade. In this case, you borrow more money, 10 times more than your account value is, and then in this case, your profit can be, I don't know, like $20. And then you make dozens, not if not hundreds of these trades per day. And as a result, you kind of can get profits daily, basically. So you see, trading doesn't matter about price, doesn't matter about the financial condition of the company. You just trade stocks going up and down, simple as that. Okay. No one joined. Okay, now marathon versus sprint. Favorite analogy of almost every investor. So once again, investing is long term, trading is short term. Investing is marathon, trading is sprint. And if you're running marathon, because the whole idea of giving your money to the stock market is to finish your marathon. Your investing journey is a marathon, and you want to finish this marathon. So you can make quick gains with trading, but investing almost always beats trading in long-term perspective. So if you take trader and compare it to investor and just take 1 year, most likely if trader is a professional, he will beat almost every investor, most likely. But then you take 5 years. 5 years, if the trader is professional, maybe he will beat more than half of investors in 5 years. But if you take already 10 years, 15, 20, 30 years, the longer the time frame of competition between trader and investor, the more chances investor has at beating trader, because long-term investing almost always beats short-term trading in long-term perspective. And trading, it's literally you need to work from like 9 to 5. It's your actual job. It's your job that you need to even do 7 days per week. You trade 5 days per week, and on the weekends you read the news, you read the newspapers, you prepare for the week, you assemble your watch list and stuff like this and that. But investing is literally 5 minutes, 1 hour per month, depending if you're investing in ETFs or in the individual stocks, and that's it. So why would I need to trade 7 days per week, 10 hours per day, if I can just spend 30 minutes per month? And still 30 years from now, I will beat almost 99% of people who are trading. And that's it, simple as that. And so the goal, like I said, is to finish the marathon, not exhaust yourself with running first 100 meters as quick as possible. So once again, investing is marathon, trading is sprint. You have the starting line. Marathon is, I don't know, 30 kilometers, 30 miles. And let's see, like who will finish fast. You have two runners. The first person is investor. The second is trader. So then the judge or referee shoots the gun to start the race, basically, yes. And trader starts accelerating so fast, runs as fast as he can, like runs quick, like, and yes, obviously he's gonna be way ahead than investor in the first half of the journey, most likely. But then trader is going to get exhausted, he's going to slow down, then he's going to start walking instead of running, then he's going to maybe even stop completely just to catch a breath and stuff like this, while investor will be constantly just jogging. He will not accelerate, he will not slow down, he'll be just constantly jogging. And at the end, trader will be like completely like no energy, no power. That's it. Like he'll just sit on the grass. I don't know. He's not even most likely going to finish the marathon. He's just going to be exhausted. while investor will just casually jog from the beginning until the end and finish the marathon and win in this investing game, long story short. And quick summary. So no one joined, I just saw. So quick summary. Investors care about their companies and stay long with their investors care about their companies and they stay long with them, growing together. You need to invest in a company. You do not care about stock prices. You might care about stock prices, let's say. So if you can do how it's called, if you want to find intrinsic value, so that you might enter position like a little bit better than you want, uh, even though like the decision when to start investing is irrelevant. It's always good time to start investing if you want to invest for 30, 20, 15, 10, even if you want to invest just for even 5, 10 years, it's almost always good time to start investing, even now, even today, because most likely in this time investments will be more valuable than you've made them when you just started, long story short. Okay, so it is irrelevant to ask, is it a good time to start now? If you want to invest for 30, 20, 15, 10 years, just start now. That's it. Like especially if you're investing in total market or in S&P 500, especially invest now. Like that's it. If you, okay, like for example, right now the price of VOO, like S&P 500 ETF is like what, I don't know, 250, I don't know, let's say. So yes, not investing in this, so I'm not tracking it, but let's say, so it's 250 right now. Okay. Okay, you can wait until 2 weeks from now and the price drops 5%. So now it's like what, I don't know, like now it's 240. Okay, so now you're like, okay, now's the good time to invest. Okay, you saved $10 and you bought shares with $10 discount, but 30 years from now the price of VOO will be, let's say, so no, 2000. So you just made, like, instead of investing from 250, you would have made $760, $750. But if you waited for the whole week or the whole month and you bought the price and you bought stocks with $10 discount, you would have made $760. So these $10 are irrelevant in 30 years because your gains are like 70 times more than this. So saving this $10, yes, okay, so it's nice to save this $10, but it becomes irrelevant. If you just dollar cost average, buy every single month the same amount of money, same stocks, you should not care. Like everything will be just average, everything will just flatten, you will flatten the curve and stuff like this. It does not matter. If you want to invest for long term, it is good time to start now. It's simple as that. Traders only care about price movements. Second difference, they do not invest, they do not trade stocks for 30 years. Traders do not do 30-year moving averages or anything like this. Maximum, I think what they do is 200 moving average, but still they use this information to base their daily trades. So like they do not keep their trades open for more than, I don't know, months. Okay, couple of months. I don't think any trader held his or her position open for more than a year. So it's like, it just doesn't matter. And in 1 year something massive can happen to the company, but like sometimes, most likely it will take longer than that to something significant to impact the performance of a company. So investing is 99% of the times more profitable than trading in long-term perspective. What I've been emphasizing since the beginning. Invest if you're investing, think about investing for the long term. Okay, there was something, I thought some notification my screen. I thought the Zoom finished recording. Okay, so if you want to invest for long term, if you want to give your money to the stock market and forget about them for 30 years, you are an investor. Like that's it. Just invest in VOO, in VTI, which is S&P 500 or total stock market respectively. In this case, you literally can invest and forget. Just literally invest in one place every single month, contribute the same amount in the same one place, and that's it. It will be more than enough. It will be more than enough to begin with. And then as soon as you start feeling comfortable investing in individual companies, yes, you might add some positions in your portfolio with individual companies, but it is more than enough just to start investing in index fund, in ETF, like VO, VTI, for example, yes, like little invest and forget. And trading, not highly recommending to anyone. Even if you want to trade, like just create a separate portfolio, I would say. Just it's like going to casino. Like you have $1,000 and expect that you will lose this $1,000, and then you can play around with this. That's it. If you start losing money, if you don't have enough money to buy some stocks, never take money from your investment portfolio and contribute them to trading portfolio. If you lost your money in your trading portfolio, that's it. Forget about them. That's all. That's this was your price for the entertainment. Like entertainment is barely anytime free. Entertainment is rarely free, and this was your price for the entertainment. You lost money, but in fact you just paid for having fun trading stocks. That's it. If you win, you win. Good job. Withdraw this money, add this to your investment account. That's it. You're done. If you lose your money, never contribute more, because it's like gambling. It's just like you'll get addicted to this, and then you'll just keep losing and losing. You will have good days, bad days, but remember, in long-term perspective, you will most likely lose to 99% of just passive investors who just invest in one place, which is either S&P 500 index VOO or total market index VTI, if I'm not mistaken. Both are available in Robinhood, well, simple, and I would say 99% of online brokerages. And I guess that's it. Not sure how much is left. I think good. We did good today. So that was the differences between investing and trading, Travis. Gabriel, if you watched all the way until this point, you're the man. Now you know a lot. Now you literally know a lot. Like, good job, Gabriel. Hopefully it was entertaining. Like, whenever I start speaking about investments, as you can see, I just lose myself inside this. I teleport inside this world. So yeah, this was investing versus trading differences. And if there are any questions, Travis, feel free to ask. Yes, sure thing. It was a pleasure as always. Thank you for joining, Travis. I hope everything was understandable. And most likely see you in 2 weeks, because next week we are flying to Colombia for Christmas and New Year. So So yeah, it's going to be Wednesday flight. Like, so obviously I will not do anything on Wednesday. It will be like almost the whole day flight. So
Nice.
most likely in 2 weeks. Most likely in 2 weeks we'll see each other.
That's cool. Have fun. Enjoy yourself.
Thanks so much, Travis. Have a good rest of the day. Thank you for joining us always.
Yes, yes. I'll see you around.
Thank you, man. See you. Thank you.